This is the S&P 500, with over $7 trillion invested in it, making it the world's biggest index and more valuable than the GDP of countries like India and the United Kingdom put together. But before we keep on dumping more and more money into this index, do we really know the good, the bad, and the ugly about the S&P 500? S&P 500 isn't actually the market like a lot of people might think it to be. It is an index, which means that this was made to track and mimic the performance of a specific part of the broader market. There are countless indexes out there made to focus on different segments of the market, from things like trading in the same currency to how good a company is for the environment. S&P 500, for example, was made to track the biggest 500 stocks listed on the American stock exchanges. The S&P in the name stands for Standard & Poor's, the company who owns the index. Standard & Poor's is an investment research company started in the 1800s, but they didn't create this index until the 1950s, originally naming it the Composite Index. While the index does have a good amount of stocks that trade on the New York Stock Exchange, this index also has companies which trade on other exchanges like NASDAQ and the Chicago Board Options Exchange. So that does add a bit more diversification in our portfolios. A quick look at the actual list of stocks will prove you that they don't quite add up to the iconic 500 that everyone knows, because these three companies have multiple types of shares in this index. For stuff like voting and non-voting rights, the 500 companies actually add up to 503 stocks. Now let's say you decided to invest your hard-earned money into the list of these 503 stocks. Well, you actually can't directly invest in it as this is an index, it is just a fancy tracker. So the way to invest in this is to invest in a fund which is made to mimic exactly what S&P 500 is doing. Usually, these funds are some of the cheapest ways to invest in the market because instead of your bank or investment company paying massive amounts to a bunch of portfolio managers, all of that is cut out as they just sit there and follow what S&P is doing. S&P does all the legwork and makes all the decisions on which company will be added to the index and which ones will be kicked out. And that isn't just one guy behind his desk making these decisions. There is a full-on committee who evaluates companies and stocks on several criterias. So these criterias are really important because not only do they make sure that the fundamentals of the company and stock are both in solid standing, they are also ever-changing and constantly reviewing the list. This list is very prestigious as when a company joins the list, they get a massive boost in their goodwill. And don't forget those $7 trillion who track this index. As soon as a company makes the list, all the index funds need to be adjusted. They do that by buying the stocks of that new company. That buying frenzy usually ends up increasing the stock price for a short period of time. All of this is done while funds start to sell the stocks of the company which was delisted, making their share price potentially see a temporary drop in value. Regardless of which companies have been on the list, this index for the past several decades has been considered a solid measure of the overall U.S. stock market performance. The last 20 years of the U.S. economy have been dominated by growth in the tech sector. This has also resulted in IT companies, and their stocks being some of the most valuable and the best performers across the board. So as this index aims to provide an accurate depiction of the broader market, it is fair that this index is a bit heavier in the tech industry right now. They are not only the biggest part of this index, but also provide the majority of the returns. If one sector keeps on dominating year after year, it should make you question if these 500 companies are actually diverse enough. Sectors like consumer staples, utilities, and healthcare are good performers when we are going through a downturn in our economy, but they are nowhere close to catching up with the performance of these IT companies. When we look at the returns of the S&P 500, there are basically two ways you can look at it. One would be the price return, which is the increase in the price of this index, and the second would be the total return, which would be the price increase on top of reinvesting any dividends paid. So when you're looking at an S&P 500 index fund, you should make sure what kind of returns you are actually looking at. Because if you're just comparing 1 or 2 years, it might not seem that big of a difference, but over decades, that could mean a difference of hundreds of thousands of dollars. So now that we know how these companies are picked, what's actually in this index, and what kind of returns we should look at, do we really think it deserves the benchmark standard it currently has? Or another index, maybe something that has a lot more companies, would be a more appropriate contender for this benchmark position. Maybe something like the Russell 3000 or Dow Jones Total Stock Market Index. Let me know what you think about investing in S&P 500. If you enjoyed the video, please like and subscribe. Thanks for watching.